So I see a lot of articles, and I'm sure that you all, our clients, do too recently, or maybe little tidbits on social media about the death of the 60/40 portfolio. And what is a 60/40 portfolio? Well, a lot of you are probably familiar with that if you've been investing for a while, but basically it's a generic description for 60% of your money invested in stocks in the market one way or the other, and maybe 40% of your assets allocated toward short-term bonds, CDs, maybe alternative type investments that aren't considered equity or stock type positions. And you know, the 60/40 portfolio has been a staple for conservative or retired investors for years and years and years. I would argue that its demise is a little bit over-exaggerated. And I'll just point to a few quick examples. We've gone through lots of historical examples of investment crazes, investment speculations, experts predicting these type of things, that a certain portfolio strategy is dead and another one is going to be the next thing. Just a few examples of some of those things in the past that faded. The Nifty 50. The Nifty 50 was a period of time in the 1960s and 70s where institutional investors, experts, and analysts predicted that all you needed to own was the 50 largest U.S. companies, and you didn't even need to worry about anything else. You just invest in those Nifty 50, don't diversify. Well, it didn't turn out that lucrative, okay? It kind of faded. Way back in the 1630s, there was something in Netherlands called the tulip craze. And basically there were tulip bulbs in a rare variety in a certain color or a variation of colors that drove prices and demand for these type of tulips that came over to Netherlands in the 1500s and the 1600s. And people were speculating on this tulip craze and these bulbs like stocks in the stock market in any of the modern times. And again, that craze, that euphoria ran out and a lot of people lost money in the tulip craze. Today, it might be the Magnificent 7 or 8, those magnificent stocks in the tech space that you can own, and you can just make money at those, and that's going to be the way of the future. Or maybe it's the days of the meme stocks a few years ago, where you just could just hop on any social media platform and just follow the craze of what people are investing in meme stocks that are being touted in memes on social media. All that to say that fads come and go. What is boring and diversified portfolios, whether it's 60/40 investment strategy allocation, whether it's buying a basket of good quality growth stocks, a good basket of good quality dividend stocks, and diversifying, whatever the diversification strategy is, that does tend to hold on for decades on end and produce reliable, consistent returns, although not near as exciting. But for the core of the portfolio, for 75, 80% of the portfolio that you want to be able to depend on to accomplish your goals, dreams, ambitions, those are probably still prudent investment strategies. And maybe with those other things, you know, maybe you sprinkle those around the core of your portfolio as a satellite, so to speak, if you want to dabble in those type of things throughout history. That's certainly fine if you have the assets and the wherewithal to do that and you want to. But just remembering that to not get wrapped up in the demise or the predicted demise of certain strategies that have been tried true and helped many of our clients achieve their goals.